Welcome back to the channel, crypto analysts and digital asset believers. Today's report is more than just numbers, it's a roadmap for the next macro move in Bitcoin and altcoins. United States inflation data just dropped, and with it, the potential script for the Fed's next policy decision and Bitcoin's price trajectory. So the question isn't just what did the CPI say? It's what will markets do next, and are you positioned for it? Headline: United States CPI comes in cooler than expected. Bitcoin shows muted but bullish resilience. At 8:30 a.m. Eastern on Tuesday, the United States Bureau of Labor Statistics released its latest Consumer Price Index report for April, revealing that the year-over-year inflation rate in the United States came in at 2% and 3%. That figure is slightly below the consensus estimate of 2% and 4%, and a modest decline from March's reading. Core CPI, which strips out volatile food and energy prices and is closely watched by the Federal Reserve, remained steady at 2% and 8% year-over-year, exactly in line with economist forecasts. For seasoned investors, these numbers might not sound explosive, but they send a very specific message. Inflationary pressure in the United States economy is cooling off, and it's doing so faster than anticipated. Bitcoin reacts quietly, but why that might be a bullish signal? Following the CPI release, Bitcoin saw a marginal decline of 0% and 3%, trading at around $103,590. At first glance, this may seem underwhelming, especially given the macro significance of inflation data. But dig deeper, and the story gets more interesting. A flat or subdued market reaction to economic news often signals that the data was not disruptive. In fact, the crypto market may be signaling confidence. Rather than panic or euphoria, we're seeing stabilization, a sign of institutional maturity. So here's the question: is Bitcoin simply biding its time before the next leg up? CPI and the Fed, the bigger picture. CPI isn't just a headline, it's a lever for monetary policy. Rising inflation historically prompts central banks to raise interest rates, making borrowing more expensive and reducing liquidity conditions that tend to hurt risk assets like Bitcoin. But when inflation cools off, the narrative flips. Today's CPI reading brings that pivot one step closer. With inflation showing signs of deceleration, expectations of an interest rate cut by the United States Federal Reserve are surging. According to the CME FedWatch tool, the probability of a rate cut at the Fed's next meeting on June 18th has climbed to a staggering 91% and 8%. That's a dramatic shift in sentiment, one that could have far-reaching implications for both traditional and digital asset markets. How tariffs complicate the outlook. During the Fed's last press conference, Chairman Jerome Powell noted that short-term inflation expectations had increased in part due to tariff-related measures introduced by the previous administration. However, Powell cautioned that the full impact of these policies might not yet be reflected in the data. He stressed the importance of waiting before making major adjustments to monetary policy. This layered complexity means that while headline inflation may be easing, underlying forces such as tariffs, labor shortages, and supply chain shifts are still being watched closely by the central bank. That's why markets are in a holding pattern. They're waiting for confirmation, not just from data, but from Fed language and forward guidance. Crypto market outlook: macro, momentum, and confidence. In the crypto world, the implications are clear. A lower inflation environment paired with a dovish Fed stance could catalyze renewed bullish sentiment for Bitcoin and Ethereum. With real yields likely to fall, and traditional assets offering lower risk-adjusted returns, digital assets become more attractive, especially for institutional capital that's already dipping its toes deeper into the space. Moreover, the broader crypto ecosystem thrives in environments of liquidity expansion. If the Fed begins easing policy, either through rate cuts or balance sheet adjustments, capital flows into high-growth, high-volatility assets could resume, with crypto being a key beneficiary. But is the market getting ahead of itself? While optimism is building, the Fed remains cautious. Powell and other officials have reiterated their data-dependent approach, making it clear that one inflation report isn't enough to shift the monetary narrative. If next month's payroll numbers or inflation reports surprise to the upside, it could delay or even derail rate cut expectations. That brings us to a key inflection point for investors. Are markets prematurely pricing in policy easing, or is the macro tide genuinely turning? Bitcoin's path forward: momentum builds below the surface. Even with a flat price response, on-chain indicators suggest long-term holders and institutional wallets are continuing to accumulate. Dormant BTC is rising, exchange outflows remain steady, and whale activity is climbing. All of this implies quiet confidence, the kind that often precedes explosive moves. But the technicals also matter. Bitcoin remains within a broader consolidation range, and only a decisive break above recent highs would signal a return to full risk-on behavior. The question is, will it be CPI that sets the fuse, or will the real breakout come after the June Fed meeting? This CPI report may not have moved markets dramatically, but its implications are significant. Cooling inflation, high probability of a rate cut, and macroeconomic tailwinds are aligning to create an increasingly favorable environment for digital assets. Now more than ever, investors should monitor not just price action, but macro signals, Fed language, and policy data. So are you positioned for a dovish Fed cycle, or are you waiting for more confirmation before going risk-on? Let us know your strategy in the comments, and don't forget to subscribe because the next data drop could rewrite the crypto narrative all over again.